Okay, well, good evening for those of you joining us from the East Coast. We've seen a few attendees already have been here bright and early, so thank you so much. We're excited for today's webinar event. And good afternoon for those of you joining us out in the West Coast. My name is Gianni Quintana, and I'm the Marketing Manager at LendingOne, and I will be your moderator on tonight's webinar. We're glad you can make the time to join us for our educational webinar entitled The State of the Market, Single Family Rental Industry. Presented by Dennis Cisterna. He's the Chief Revenue Officer at Investability. So we want to thank Dennis as well for co-sponsoring this educational webinar and being the featured presenter today. Along with him, we're going to have our very own co-founder and COO at LendingOne, Matt Neisser, who will be discussing direct private lending financing. A little housekeeping. Maybe we'll give a couple minutes for people to join in if they're coming from work or stuck in commute. So, but before we like to go over some real quick housekeeping logistics for this webinar. As you know, we're using GoToWebinar, and you'll see that you have a chat box in the bottom of your widget. Please feel free to use it and send us a chat during the webinar. Questions will be held or Q&A to the end. You're on listen mode only, so there's really no way to kind of ask a question via audio. As an attendee, you're going to be able to just send out chat questions, like I said, and I'll make sure that they get answered to the best of my ability by both Dennis and Matt towards the end of the Q&A period. We'll try our best also to record this webinar, and if we do, we'll be able to send that out, the recording of it as well, within the next couple days via email. So without further ado, let me pass it along to Dennis Cisterna. Dennis?
Gianni, I appreciate it. Thanks so much, and thank you for all the folks attending right now. Over the next 45 minutes or so, I hope to cover what really can summarize where we're at in terms of the state of the single-family rental industry market, how it's evolved over the past several years, and some really key insights about what to look for in this market that can help you as an investor. So throughout this webinar, I'm going to share with you folks some information at a high level about the overall economy, the housing market, specifically what's going on in the rental market, and then start really digging into the weeds about some of the key trends that are going to affect what to do and not to do in this market and things to be aware of. Before I begin, I just wanted to give you guys a little color on what Investability is if you're not familiar with our firm. You may have heard of our sister company, RentRange, which is the largest data provider in the single-family rental industry. And we created Investability to really take advantage of that data that was being used by Wall Street investors and being able to help convey that information to smaller investors so they became a little bit smarter about the markets that they wanted to invest in. And as Investability has grown over time, we've really become a one-stop shop for investors of any size. We have our entire database of over 10 million plus rental homes put onto a search and acquisition platform similar to Zillow. So we layer our investment data on that to help investors make decisions on more than 800,000 MLS properties. We also have our own exclusive listings on the site, and because we're a part of AltaSource Portfolio Solutions, which is a big vertically integrated service provider in the real estate space, we are really an end-to-end solution provider for investors. So whether you wanted to analyze or purchase or renovate or lease or manage or finance or sell your property, either we can do that internally or we do that with one of our best-in-class service providers, folks like LendingOne, who can step up those services that we don't offer. Really unique website, really cutting-edge stuff, so I certainly would encourage you guys to take a look at it when we're done with the webinar. That is really the last time you will hear me pitch anything about what I do. I'm really here to help educate you guys on what's going on in the market. and hopefully you take away it and can benefit from that information. So we are going to start really looking at the economy at a higher level. A couple key trends to be aware of. You may have heard that the Fed is interested in raising interest rates, and they have said they're interested in raising interest rates for literally the last 23 meetings they've had in session, which spans several years. And over that time, the number of interest rate increases they've had is one, totaling only 25 basis points. And the reason for that is generally you're putting interest rate increases in place to temper a growing economy. And while our economy is getting better, it is not rocking and rolling to the point that would require the temperament of reducing interest rates. And that's very clear when you look at GDP growth, which is our gross domestic product. Keeping GDP year-over-year growth above 2% is ideal in an expanding economy. And as you can see from the slide here, we've had a very difficult time doing that on a consistent basis. So while we're definitely in positive territory and have been there for a number of quarters, it's not quite strong enough to be able to drive up inflation and push those interest rates down, or push those interest rates up. Another big factor in keeping interest rates down has really been the employment situation. So the most recent Fed meeting talked about how the employment numbers were not quite as strong as they had hoped, and that's what caused them to keep rates stagnant. Now you'll see here that the unemployment rate has gone down, down, down for the last 6 years basically, since the recession was in full tilt. What this doesn't show you is the number of folks that have basically left the job market. So this number is great on the surface. Most economists think anything under 6% is deemed full employment. But because there are so many people that have left the job market, and because the rate of employment growth has been good but not great, you got to remember how many millions of jobs we lost during the recession. That again has also tempered the economic growth in this country, which has kept interest rates down. And I'm saying this because as we move to the next slide, where we look at consumer confidence, this probably isn't surprising either. When we're surveying the normal populace of America and we try to understand how do they feel, what is the sentiment about where the country is heading from an economic perspective, you can see we've been basically between 90 and 105 for the past 2+ years. And while that's good, and certainly better than it was during the recession and even the ensuing years after the recession, it's not consistently in that 100+ area, which is another good sign of economic growth. As we look into some existing and new real estate trends on what's going on, one thing you'll notice here is existing single-family home sales have started to rally back up. So now we are on an annualized basis of somewhere around, 5.2 to 5.5 million, for most of the last several quarters. What you'll probably also notice on here that's a little alarming is the number of new single-family home sales, which is a far cry from the peak of the market. And obviously having, over 1 million+ home sales a year, new home sales a year, is not necessarily sustainable. What happens is when you have a decline from the peak on existing home sales and decline from the peak in existing home sales, even though you have a growing populace, the issue is, well, now you have a lot more demand than you have necessarily supply. And that's what's been going on in a lot of markets as of late. Obviously, there was a tremendous amount of foreclosure activity during and post-recession, and those numbers have basically dwindled to the point where I was at a conference 2 weeks ago that was a collection of the biggest REO brokers in the country, and the big message to the REO brokers was basically find another line of business. Not that you couldn't be successful as a broker anymore, but the fact was REO inventory was declining at such a rapid rate that if you wanted to have, potential to grow your business as a realtor, you needed to find other lines of work, like working on properties for investors, because that's really a big segment of the market that's growing. And that's what I'm going to really highlight now, is taking all these economic factors I just mentioned into account, along with a handful of other factors. It's really the perfect storm of different metrics that allow for sustained growth in single-family rentals. So I listed quite a few here that I'm going to go over quickly so you guys get a little bit of color on what we're dealing with here. So let's start with number one. It is hard to get a mortgage. And because it's hard to get a mortgage, because credit standards have tightened dramatically from where they've been, that has pushed a lot of potential homeowners that would like to own a home into rentership. In addition, you've had home prices skyrocket in a number of markets. San Francisco, San Diego, LA, Denver, Miami, all come to mind. And what happens is that pushes, when you have that kind of home price appreciation, it doesn't just happen for luxury homes or move-up homes. It happens across the board. And when that happens, you start to price out different segments of the market. And when we're talking about single-family rentals, by and large, across the country, those homes are priced between $75,000 to $250,000. So you can imagine what happens when you live in Los Angeles, where the median price has skyrocketed over $500,000 again, how people can get priced out of that market, especially if they don't have the down payment necessary to be able to obtain a non-conventional loan. So you have all these other factors that are messing up people's abilities to actually save money. You have income growth slowing compared to the cost of home prices. You have people's personal savings rates declining, which is amazing to me. Coming out of this recession, people, I would have imagined, would have quite kind of understood the downside of over-leveraging themselves and starting to try to tuck money away from themselves, but that's not happening either. You also have a growing percentage of the population that's saddled with large amounts of student loan debt. So all of those things are playing into the inability of someone to actually own a home in many markets across the U.S. Now, there's some other good news that's going on, at least from a national perspective. As I mentioned before, unemployment, even though there's some underemployment, it's still going down. There's less and less people that are unemployed right now than they have been in quite some time. You have, because of that level of demand and because of that level of job growth, as well as the population growth. So I put in there household formation. Our population continues to skyrocket, and there are certain markets across the U.S. where that employment growth is stronger than other areas. And because of that, you really start to see a couple of dynamics go into play here. One of which is you have more demand than supply of available housing available, and because of that, you have vacancy rates dropping, you have rents increasing, and you also have a number of rental options that have increased. As you guys have probably noticed, as Wall Street has entered this space, as well as a bunch of other larger or middle-sized investors, they have kind of changed what's the best way to put it? They've changed the stigma of being a renter in America. Because of how many people lost their homes during the Great Recession, a lot of people think it's okay to be a renter right now. In fact, a lot of people actually favor being a renter right now. You see in there my demographic factor of desire to own a home. People's desire to own a home that are under the age of 40 is less right now than it has ever been in the history of tracking these kind of statistics. And that's a big issue. So not only do you have people that want to own homes that can't, but you also have a bunch of people now that maybe wanted to own a home in the past, but don't anymore. They like the mobility and the flexibility of renting, especially as they can rent a single-family home that's well-sized for their family versus an apartment. The last thing to consider for this perfect storm is really how, and I'm sure some of you guys are taking advantage of this now, is how much easier it is to own and operate an investment property. Even though Wall Street does not own a big percentage of the number of single-family homes in this market, because on an individual basis they own billions of dollars of single-family homes, at least the top few guys, that brought with this industry a maturation in terms of national and regional service providers that are available. As LendingOne is a great example of, it helped the capital markets mature. Once Invitation Homes and Colony American and some of the really big guys, or Colony Starwood as they've gone through a couple mergers, once those guys got the attention of Citi and Wells Fargo and Deutsche Bank to start issuing large lines of credit, that started getting other parties interested in financing this market. And as I'll explain later, that market gets deepest with the smaller investor. And that's why guys like LendingOne and a handful of others have been able to have such great success in this market, because those financing options weren't even available a couple years ago. So your ability to expand your portfolio was severely limited, usually from a capital constraint. You have all kinds of awesome software and application advances where you can now get all your tenants to pay rent online. You can use an asset management tool that big multifamily REITs used 2 years ago and is now available for a guy that owns 5 houses. You also have access to more market data now. Big data has really helped become a game changer for the smaller investors in this space. And I mentioned earlier that we own Rent Range, and part of Investability's goal is really to give more clarity and transparency to the smaller investor in this space. And now you also have access to more properties than ever before. You know, I said before that Investability has this platform where we have 800,000 plus properties. Obviously, you can go on a place like Zillow or Redfin, and you just have more of an idea about what's going on outside of your own backyard. Historically, investors only pay attention to the markets that they live in because that's safe, it's something they understand. But now, as more and more information has become available and more access to properties has become available, you can start to look for better opportunities. If anybody on this call lives in Los Angeles or San Diego or San Francisco right now, it is tough sledding to find an investment property, a residential property that pencils as a rental. And so does that mean you should be denied the opportunity for a good alternative investment just because you don't live in Chicago or Dallas or Indianapolis? I don't think so, and luckily the market agrees. It's starting to give you clarity into what's going on in the market. So all of those factors really are at play here in pushing up the number of single-family rentals. To give you guys a little bit more color about this growth in household demand, look, the country gets bigger every single year, and people are either going to rent or they're going to own. So if you look at the household growth that we've had over the past 5+ years, including a 2017 projection, the number of homeowners we have every year is going down. The number of renters we're having every year is skyrocketing, and that's a great opportunity for you guys as investors to take advantage of what is sustainable growth. And obviously this isn't going to last forever. Either at some point somebody is going to want to start making silly mortgages again, or they're going to loosen up credit standards where you'll start to see a shift back. But it's not going to be a free-for-all like it was pre-recession, where a guy that earned minimum wage could get a $400,000 loan in his sleep because he didn't have to show documentation. to get that loan. We don't see any of that quite on the horizon right now. So in terms of looking at your opportunities, we really like where the percentage of household growth is heading. And for those of you that think this is somewhat of a new phenomenon, without a doubt, it's expanded dramatically post-recession, and that's because those housing units have to go somewhere after they were foreclosed upon. And it wasn't just the big Wall Street investors. It was middle-sized guys. It was mom and pops. It was basically anybody that could get a loan at that time or had a buck to spare to invest in. But this market's been around for a long time. We've had 8 million plus rentals in the U.S. that are single-family for 40-plus years. What's great about this industry now is it's a little less fragmented, even though it's still fragmented, but you have all these tools and resources that weren't available to you before. I don't know how to say this. If I owned a single-family house in 1973 and it wasn't in a 10-mile radius of my house, I don't think I would have even had the ability to own or manage it. Today, you could own a portfolio of 50 houses spread across the country that are managed by professionally rated, best-in-class operators that are giving you full transparency on how these rental properties operate. I think that's just a game changer. And we're going to continue to see that number of rental properties increase, as I've indicated earlier. So let's look at a couple of the trends in the single-family space right now, namely rents and vacancy. Because you have this perfect storm of demand for renters and rental properties, not surprisingly, rents are going up. Now, in some markets, rents go up just as fast as home prices. In other markets, they go faster, some they go slower. But what you generally are going to see here is that in the majority of the top 25 markets, you've had significant rent growth over the past 4 years. So if you bought a property in 2012 and it made sense as a rental then, you're feeling pretty good about yourself right now because your property has, the rent's appreciated 15%, never mind the property value appreciation. And so not surprisingly, in some of these coastal markets, San Francisco, Los Angeles, San Diego, New York, Miami, the rents have pushed up higher and higher. The issue is, in most of those markets, really in all those markets, the home prices have appreciated more and more, so you're starting to get some yield compression. So you're not quite getting good deals, not surprisingly, in these coastal markets. But you look at places like Charlotte or Tampa or Portland or Chicago, where you've had a nice little bump in rents, and you've seen a moderate increase in home prices, so you can still get good bang for your buck, and you're also getting better yield than you did originally. When we look at vacancy, it's a very similar picture. The national vacancy rate for single-family homes today is only 7%. So that means it's across the entire country, 93% of the single-family homes are occupied. That is a great number. That's a great idea to give you the stability of being an owner of a rental property right now. That means if you want to renew your tenant to another lease, chances are you can, and if you don't want to renew them, chances are you can bump rents for the next guy. So when we look at the top 25 metro areas, we see the vacancy rates even lower. 4 years ago, it was 6.1%, and these are generally larger metropolis areas, and now it's 5.4%. And if you look at, again, some of these coastal cities where home prices have started to outstrip, home price appreciation has started to outstrip the rental appreciation, you see vacancy at incredible rates. Denver, LA, Seattle all have vacancy rates below 3%. That is an investor's dream, without a doubt. So, and there are a number of other markets that are just great demand and just not enough supply. A lot of these places have basically turned off the faucet of new home building. Permit issuance is down substantially in a lot of these markets, and because of that, people still want to live somewhere, and they have limited options. So if they're not buying and pushing those home prices up, they are renting. So again, some great fundamentals in place here for investors, and certainly a lot stronger fundamentals than we've seen. I mentioned previously how smaller investors, or historically investors, have stayed close to home. So this is a little snapshot of investors by the number of properties they own. So if a guy owns 1 or 2 properties, 70% of those guys only invest in a 10-mile radius. If they own 3 to 25, 50% of them are in a 10-mile radius. But as you can see, as the investors get bigger, they become a little bit more sophisticated. And this was my point earlier about taking advantage of market information that is out there and readily available to be disseminated and analyzed. It's phenomenal to me that more people are not exploring, these stable markets in the Midwest where yields are really good and you have service providers available. I think we'll continue to see this to shift, though. As I talk to more and more smaller and mid-sized investors, they're starting to understand that they have more information at their fingertips. They have providers, service providers that can really help them navigate those markets, whether it's a broker or a property manager or a contractor. So I think this slide, you'll see a continued shift downwards where people will move further and further away from their house as more information becomes available. Even to give you some perspective, so our company, Rent Range, if you go to Rent Range right now, well, not right now, don't leave the presentation here, but if you go to Rent Range later, you can get a report on what the estimated rent is on over 10 million properties in the U.S. I cannot fathom that being available just a handful of years ago. And it just makes investing that much easier. It gives you confidence in what you are trying to assess as a good or bad opportunity. This is a really interesting slide. So I think you guys are all going to be surprised when you see this if you haven't seen it before. This is a pretty common slide that I use when I give presentations, and it's really for people to understand that even though there has been countless press about the Wall Street investors coming in and buying up foreclosures and Wall Street taking over Main Street, take a good look at this slide. No doubt, these guys have been, the top 19 guys have invested $34 billion. None of these guys are messing around. But all of them combined own 200,000 houses, which on the surface is a lot. And certainly $34 billion is a lot of money. But we're talking about the entire U.S. single-family rental housing stock of 15 million plus homes. They own almost nothing. They own a little more than 1%. And what's amazing is these guys have been highly successful in what they do. They've helped really modernize this asset class. And we, as small investors and mid-sized investors, get to take advantage of everything that's happened because of the big money they put into this. And as people started to understand the space, they said, wow, well, they own $34 billion worth of housing. All the service providers, all the banks, all the private lenders, all the property managers said, well, yeah, they own $34 billion, but this is a multi-trillion-dollar market. I want to start going after the other people. And so when we start to break down how this market is, who is it made up of? And that's really our next slide here that I want to give you color on. 37% of the properties owned in this space, they're one guy that owns one investment property. And I'm guessing that the vast majority of those guys either just bought their first property or have owned them for a long time. And as you move down this funnel, you can see, obviously, it gets a lot tighter, a lot quicker as you move up in the number of properties owned by people. What's interesting is, fairly consistently across the board here, the average bandwidth, the average value of people of any portfolio size that anybody owns, it's within $100,000 total, $50,000 each way. So it's somewhere between 128 to 230. That's the entire universe, the average portfolio size. Now, obviously, there's guys that own $400,000 houses and $500,000 houses and $50,000 houses, but this is really kind of the meat of the market. And so, as an investor, you kind of wonder, well, where do I fit in here? What does this mean? If I own 2 properties, am I the same as the guy that owns 4 properties? Am I the same as the guy that owns 26 properties? And the answer is sometimes. So what we like to do here is we kind of break people down into little consumer segments about who they are. First time Fred is what it sounds. He's got 1 property. He's okay with that right now, and that makes up a large part of the market. You know, there were 685,000 first-time Freds last year that bought their first investment property. Your next stage is your learning Larry. That's a guy that wants to grow a portfolio, but he's still new to it. He may not know all the ins and outs of, renovating a property or finding the right type of financing, but he's getting there, and he's improving the size of his portfolio, albeit slowly. That person has only grown their portfolio by 1.5 properties over the last 12 months. And as you move up the chart, you get a more sophisticated investor who, instead of an alternative investment, it starts to become a business. And so when you start to get into Company Cody and Middle Market Mary, those are folks that are really running a business around their real estate. And not everybody wants to do that, but it's a growing percent of the entire segmentation of groups that are wanting to operate like a business. So even if it's an old rich guy that happens to have a couple employees and has, they're growing their portfolio, I will tell you what, the biggest advantage an investor has today, and Matt will cover this a little bit later, is the way financing has evolved. The fact that you can unlock attractive debt through a variety of mediums right now in pretty much every state across the country, it bodes very well for someone that wants to be a learning Larry and he's been stuck getting Fannie or Freddie loans his entire life, now can get a portfolio loan and double down on his investment. Or someone like Small Business Susan or Company Cody who goes and gets a line of credit so they can start growing their portfolio. And those financing tools just didn't exist before. So it's really unique to see how these groups kind of grow throughout time and how some of them become more active as more tools and resources are available to them. That is a duplicate slide, so sorry about that. Let's talk a little bit about the actual markets. Always talking at 30,000 feet is good to make sure you're investing in the right thing and in the right opportunity. But now that we're convinced, and I'm guessing everyone here is an active investor of some type, where do you invest? Why should you invest where you invest? So we're going to start, again, a little higher level. What are the biggest markets by investor sales? This does not take into account if someone holds them as a rental or someone uses them as a flip. So as you can see, part of this is just driven by pure population. New York is a giant market. Miami, giant market. Detroit, super distressed market. Chicago, giant. Dallas, Houston, LA, giant. Tampa, distressed. Philly, giant. It goes on and on. And each of these markets has a little bit of a different story to tell about why investors are drawn there. If you go into LA right now, I can assure you most of the activity happening in that market are flips. And the reason for that is twofold. Number one, pricing has gone absolutely crazy, so long-term rentals don't really make sense in the majority of the market. And number two is because Los Angeles is a city with a lot older housing stock, houses built, the majority of houses in LA were built in the 1940s to the 1970s. You have a lot of houses that are ripe for renovation that can then be sold at a premium once they're fixed up. You look at a place like Detroit, it makes sense to both flip and to hold long because of this pure level of distress Detroit experience. You go into places like Buffalo, Buffalo never really, that's 20 on the list, Buffalo never experienced a crazy amount of distress during the market. Their economy is kind of okay. What Buffalo has always had is a high number of rental properties relative to the homeowner properties, at least compared to the national average. So you always see investors going to Buffalo saying, man, I can't believe I can buy an investment property for $100,000, $120,000 that's going to give me a net yield or a cap rate of 8, 9, 10%. And because of that, that market continues to take a lot of investor sales relative to the overall sales volume for that market. So this doesn't tell the whole story, though. This just tells you how big each market is and how many investor sales there are in it. So then let's look at it from a rental perspective. When we look at gross yields, and gross yields is just your gross potential rent divided by the purchase price of the house, it starts to get into focus where the opportunities are. As I had indicated earlier, the West Coast from Seattle all the way down to San Diego, it's toast. It's so hard to find a good investment opportunity there when it comes to a long-term rental. Same can be said with a lot of areas on the West Coast, surprisingly even Wyoming. But when you start to look at some of the other hotter markets in the Sun Belt, Texas, Louisiana, Alabama, Florida, Georgia, all the way up to North Carolina, you start to see markets, and each one of those little dots represents a different county. You start to see more opportunity. And generally those are areas that did not get quite as destroyed as places did in the West Coast or Phoenix or Vegas. Obviously, Florida got hit very hard, but Florida has rebounded nicely. Tremendous amount of job growth going on in that state. Home price appreciation hasn't been crazy in most of the state, which leads to it still having good yield. So you can see kind of where you kind of fit into this. You might be living in Arizona right now saying, man, it's hard to make sense of something in Phoenix right now. Lo and behold, you have a couple opportunities in New Mexico nearby. Texas is on fire with their overall job growth. The economy there is just doing awesome. They have done such a good job at recruiting new businesses into that state, and because of that, just job growth and population growth has been on fire, and they have remained relatively affordable markets because they have the availability to build quite quickly throughout most of Texas. Obviously, yield is only one part of it, right? There is the appreciation factor, and one of the number one rule I tell investors who ask me what their investment strategy should be is do not base your sole objective on appreciation, because it is speculative in nature. Even if you understand the market, its economics, its demographics down to a T, you don't know, I don't know, economists don't know what's going to happen with that market tomorrow. So if you're just banking on the upside, and especially if you're leveraging, you're really putting yourself in a tough spot where you potentially have to come out of pocket to cover the debt service. You might have to come out of pocket even if you pay all cash just to cover the operational overload of property management or taxes or any kind of maintenance. Now, some of these markets have really been a kind of have your cake and eat it too situation over the last several years. Atlanta, Las Vegas, Orlando, Tampa have experienced good, solid yield over the last 3 years and also significant price appreciation. Now, you look at a place like most of the markets I just listed, those were markets that got absolutely buried by the recession, so it's not a surprise that they have appreciated back up to a level they were, higher than they were 3 years ago. But what's interesting about some of these markets, especially a place like Las Vegas is still 34% cheaper than it was at the peak, and we are a decade plus removed. So even if you looked at what price appreciation should be historically in Las Vegas, it's still under what that benchmark should be. So it's nice to get appreciation. It shouldn't be your main strategy, but you can see it be an absolutely home run 3 years ago if you got in a market that was making sense from a rental perspective and you also got the benefit of that appreciation. So I always like to tell people, go for the yield. If the appreciation happens, so be it. And that really comes from you understanding the fundamentals of the market, knowing that there's going to be more demand than supply, knowing that they have the right economic fundamentals in place, and you can take advantage of both. A few more slides here before I hand it over to Matt. I mentioned before that Wall Street only owns 1% and change of the entire rental market. Yet if I ask most investors, they will tell me at one time or another that they got outbid by Invitation Homes or one of the other big guys in their market. It happens, especially if you're in one of the handful of markets they're in. This slide, each of those little dots represents the average gross yield this year for a particular county. And so you see that little red box I did, that's kind of where the institutional, the Wall Street guys focus on buying their properties. Between that $120,000 to $225,000 range, gross yields around a 9.5 up to about a 12.5 or higher. And what you see here is a ton of dots to the left of the institutional target. So if you could buy a little bit cheaper, or maybe you guys already are, I have seen a tremendous amount of investors have awesome success in that $80,000 to $110,000 range, where they are buying properties with a 15+ gross yield, which is equating to a net yield of, or a cap rate of 7.5% plus. That's a great return on your investment, especially when you don't factor in appreciation or any kind of additional returns you might get from using leverage. It's also important to note, all those boxes that are in the institutional target, there are hundreds, at least dozens, if not hundreds, of counties in that box that the institutional investors are not in. So there is only about 15 different metro areas in the U.S. that the biggest 19 guys are focused on. Atlanta, Miami, Orlando, Chicago, Charlotte. It's really not surprising if you're in one of those markets that you've ran up against them. But, you know, if you're in Oklahoma or Indiana or Alabama or South Carolina, you can be right in that box, if not better, as long as you're diligent about what cities you're in, being in the right areas, being in the right opportunities. But the opportunity to still succeed in buying rentals is out there. It's just a matter of you exposing yourself to those markets. So I have a lot of investors that come up and ask me, well, man, home prices have appreciated so much. I can't make sense of any of this. None of this pencils anymore. And in some markets, they're right. So what I looked at here was, for those same 970 counties, I looked at what the average gross yield was 4 years ago versus what it is today, and then I tried to kind of break it down for you guys to understand what that looks like now compared to then. So you have roughly 6% of the market where it says a large decrease. Those are places where the average gross yield in 2012 was 14%, and now it's only a shade under 9. That's a huge decline. Now keep in mind that's only 6% of the market. Your next level down, you've got 36% of the market, a huge slug, where you see that the average gross yield has declined less than 200 basis points. Not that big of a deal. You know, a 9 gross yield is not a home run, but maybe if you're a good operator or you're buying above the norm in those markets, you don't really feel an impact. And in those markets, you typically have seen home price appreciation outstrip rents by a little bit. Not a tremendous amount, but a little bit. And then we look to the meat of the market. Nearly half of the market is pretty much in the same ballpark as it was 4 years ago, where the average gross yield back then was 9.5. Now it's 9.4. Not a big delta. And again, you have, because this is the average of hundreds of thousands of properties for each one of these little sectors, you still have the opportunity to succeed and have good, strong gross yields today in those markets. And then, of course, you have 11% and change of the market that actually have gotten better. And those are places where you see rent growth outstripping housing demand. One of those markets is Little Rock, Arkansas. And I will be honest with you guys, I have never paid much attention to Little Rock, Arkansas, except for when Bill Clinton was running for president the first time and I had to figure out where it was on a map. Looking at Little Rock, Arkansas right now, good, strong job growth. They don't build a lot of homes. People in Little Rock metro area cannot qualify for mortgages at a much lower degree than most metro areas of their size. And because of that, you have seen rents jump like crazy. I think the number for Little Rock over the past 12 months, rent has grown 14%. Home prices have gone up 1%. So you can understand what that does for you as an investor, whether you bought a year ago or you bought today. You know, those rents are good deals. They're leading to strong gross yields, certainly better than they were previously. And so, again, this is about using the available market data that's out there. I would encourage you guys to check out investability.com and see what it's like to explore just a market you're not in. I don't know where you know, all the guys listening are, but just go look in Indianapolis, go look in Little Rock, see if anything catches your fancy. I think you'd be surprised. It's just amazing what's going on in markets that you really haven't paid attention to before. You know, go back. I think that after this is done, LendingOne's going to make this presentation available to you guys. Go back and look at this yield map that I'm going to right now. Compare that on Investability or Zillow or anywhere you want, and I think you'd be surprised at how true this rings in terms of what the opportunity is right now. So again, yes, there are some markets that are experiencing a decline in gross yields, but the majority of the markets are either stable or actually improving, which again goes back to the fundamentals of what we talked about. This is the perfect storm for long-term growth in renters. Couple things to go over real quick here. I've got a lot of questions lately about, is there a national housing bubble? And there's a couple things I just want to highlight for you guys here that aren't on the slides. Number one is I don't see it at all. I've been a housing market analyst. I've been a developer, an investment banker. I can slice and dice data with the best of them. And I will tell you there's a couple big things that happened during the housing crisis before that aren't happening now that are really easy to understand. Number one is subprime debt, which is just bad mortgages. At the peak of the market, we were doing $620 billion of subprime mortgages. Many of those included non-stated income document loans where people could just say, yeah, I make 200 grand, and they say, okay, sounds good. Today, the number of subprime loans is only 56 billion, meaning we're doing 91% less subprime loans than we did at the peak of the market, and it only makes up 5% of the total mortgage market versus 20% at the peak. Because of that, your chances of default and distress in the real estate market are far less. Also factor in that it is so much harder to get a mortgage now, and even the mortgages that do get approved are put through the ringer. Any of you that have done a owner-occupied mortgage recently understand just how complicated and laborious of a process that is. That alone should give you comfort that we're not onto this big surge of defaults. Are home prices appreciating in certain markets? Yes. There's always the chance for regional bubbles. You know, the condo market in Miami went crazy for 4 years, and that was really driven by inorganic demand from Latin American investors, and now that market is flattening. But it's not dropping like a rock because there's not this big surplus of inventory all of a sudden. Additionally, you have new home demand or new home construction at a fraction of what it has been historically. In fact, the number of new homes that were built this year in the last 12 months. We're at 490,000 new single-family homes built. And if I told you the last time that we were at that number was in 1961, when the population of the U.S. was only 200 million. So I'm talking about when John F. Kennedy was president and the country was roughly 60% of the size it was now, we were building homes to satisfy the demand of a population from a bygone era, and that's what we're building at today. So we're not adding enough supply to not only keep up with the current number of households in America, but we're not being able to satisfy the demand for that new household growth as well. And that's why you're just seeing this continued demand and push into rental properties. So hopefully that makes you guys feel a little bit more comfortable that, A, we're not on the cusp of a bubble just because home prices have gone crazy in San Francisco and Austin and Denver. All three of those markets, by the way, have experienced phenomenal job growth. That price appreciation, while it may not be sustainable for the long term, is based on organic economic demand. So at the end of the day, yeah, San Francisco's not going to appreciate forever, but it's not going to drop like a rock. It's just going to start to slow down and stabilize in its pricing because at some point only such a percentage of the population can afford that housing. So I hope that gives you guys some color on what's going on in the single-family market, in the rental market in particular. A couple quick information points for you guys here. If you are interested in buying or selling a property through Investability, we actually list for investors both big and small. You can reach Aviv Rubin, who's our senior manager of dispositions, and his contact information below. And then as a thank you to LendingOne for hosting us today, we wanted to offer 20% off to any of the listeners off any data purchases they want to make .com, and you can visit the site and see all kinds of cool data products we have for this sector. So I certainly appreciate the time today. I hope what I provided was insightful, and I am going to turn it over to Matt, the founder and co-founder and COO of LendingOne, to talk a little bit about their product.
Thanks so much, Dennis. We really appreciate it. And as we always do these, we try to make sure we're providing good information, quality topics, and we really appreciate all the insight that you provided. I know it's a little bit data heavy. We will definitively distribute it out. You guys can review some of the things. If you have questions, you can follow up with us. You can follow up with Dennis. We like to have our customers educated and really knowledgeable so they're making good decisions. So we really appreciate having someone like Dennis can provide so much insight. So, as Dennis mentioned, there's been a real big transition in lenders and types of financing out there. And ourselves started, just many of you may or may not know, we started ourselves as one of our affiliates we're real estate investors. And we ended up owning 400 to 500 homes at one point, ended up having 150 single-family rentals, and just we found the frustration with getting financing ourselves, and we decided, you know what, we think we can do this, and we understand the business really well and where customers are struggling to get across the finish line and just create a great customer experience for people. So that's really the genesis of how we started this business and how we've been growing it, is just providing good customer support. So I won't pitch us too much, but really, again, we provide rental loans. That's 30-year fixed loans, probably one of the only few people in the country that are providing this type of loans. Myself and Bill Green founded this company. It's been almost 2 years now. We worked together for almost 10, and we both have a lot of real estate investment experience. So almost everyone, I think 9 out of 10 people in our company have owned, invested in some capacity, or managed properties that we own ourselves. So we think of ourselves as real estate investors that happen to stumble into lending, and just that's how we got into the business. Most of my time now, outside of running the day-to-day business and figure out all the fun things it takes to get a mortgage across the finish line in a couple weeks versus months, I like spending my time with our investors. I have such a wide range of clients, anywhere from one doing their first transaction up to 500. So right now I spend a lot of my time working through and trying to help people build their portfolio. So that's really again, on most of my day and how we think that we try to help people a little bit differently than most folks. So, as far as our products and generally like how we help people, I'll blow through this very quickly, and then we'll get to the questions and answers so you guys can try to ask some good things and try to get some insight from myself and Dennis. But the core type of financing we provide, fix and flip financing, that's a real good part of our business. That's across 40 states right now. Very, very competitive on rate, terms, and leverage. So we're able to take people and take their portfolios hopefully from 2 properties to 10 properties or 10 to 20, whatever their scenario is. And then once we got that down pat, we really think that we're one of the most reliable lenders on fix and flip. We went into the long-term rental financing, and that's for all the folks that are on the call for long-term 30-year fixed rate loans. And that's really a product that, again, only a few of us in the country offer right now in a private fashion. And we're not a bank. We're a private lender. Our underwriting standards, we look at real estate investors. Does it make sense? Does the deal itself and the property cash flow, like Dennis talks about, is the yield there? And the primary decision on it is, does the property cash flow and does it make sense for you as an investor? So that's enough about sort of LendingOne and about our products. And if you guys are interested, I'd rather take the time to talk about questions and answers that you can ask Dennis and open it up a little bit. And again, Investability is a good partner because the Rent Range project is actually a data provider that we've used in the past, and I think it's really, if you haven't checked it out before, it's something we use internally, along with a number of other data points. Like Dennis said, we wouldn't be able to do this business 10 years ago. We're able to lend in 40 states because we have so much data available online, and also coming down and talking to investors like yourselves on the line and understanding different markets, and then supporting that with the data that you're able to get from a Rent Range and some other data providers out there. So what I'd love to do is, again, thank Dennis for his time, and more importantly, open up the floor for any questions that might be out there, and then we can go to some questions that came in before the webinar started as well. So, Johnny, if you're on, if you could just open it up for questions at this point, that'd be great.
Yes, go ahead. I'm sorry. Is that Dennis?
Now,
It wasn't me.
See if there's any. I don't know if there's any questions polled there. If not, we can get to one or two that we came in before it started.
Sure. Yes. I have here a question about for Dennis on the data around the single-family rental market in concentrations of the country that are experiencing less foreclosures than had previously in the prime of the foreclosure market. What's sort of like a rental strategy for those folks that are trying to work in those markets?
In markets that weren't necessarily hit by foreclosure?
Correct.
Got it. So I would say probably the case study for a market like that is a place like Indianapolis. In fact, if you kind of mapped where foreclosure activity happened in the U.S., it's kind of like a big smile that happened pretty much from California all the way down across the Sun Belt up towards the eastern seaboard. A handful of other markets experienced some pain, but generally speaking, the Midwest and Indianapolis in particular are good case studies for what to look for. And I use Indianapolis because a lot of people ignore the Midwest. Most people tend to see that people are moving to the West or East Coast or the South. They're mobilizing out of the Midwest. A lot of that is really more out of the Rust Belt, Kansas, Oklahoma, places like that, versus Illinois, Indiana, Cleveland, or Ohio, excuse me. Those markets, because they have generally diverse employment bases and because they are regional hubs of activity, even if they don't have millions upon millions of people that live there, they don't necessarily warrant a tremendous amount of new home growth. They have a consistent employment base that it's always kind of made sense to own a rental there. So when you're going into a market like that, you're more apt to look at what the annual yield is of the property than what the appreciation potential is. So, you know, I look at a place like Indy, and if I could just slide back real quick here, I think, you know, if you look at Indy here, what you'll notice is Indy doesn't appreciate a whole lot, but it's got a nice piece of yield going for it right now, and that's pretty consistent. That was consistent before the recession, during the recession, after the recession. Whoops, excuse me, kind of lost it there. And
Yeah,
so we look at those markets.
Yeah, we actually owned a number of properties in Indianapolis. I mean, that's you know, one of the advantages. We weren't really bidding against institutional folks at the time.
Right. That's a good point, Matt. You have less competition in those markets as well. You got to remember the big institutional guys got into this as an opportunistic play. They were getting into it because they were buying in markets below replacement cost. And while you certainly could buy cheap in a place like Indy or other markets like it, you weren't getting this huge discount because there wasn't the foreclosure volume that other markets experience.
Good example of that is even Pittsburgh. Traditionally, you don't think of Pittsburgh as a hot market, but you have a lot of good employment base there. You have PNC Bank, who absorbed some banks during the recession, growing. You have Carnegie Mellon. You have a large medical hub there, and a lot of old housing stock that's not necessarily being, there's not a lot of new ground up there. So we actually find some folks there in Indianapolis, like you mentioned already, that there's still good rental yield, and you didn't have the boom and bust like you had in other areas. I think it's more like akin to maybe like a Buffalo, like you said.
Absolutely.
Johnny, is there other question or two before we go to any ones that were sort of posed pre? Johnny, you there?
Yes. Hi, I hear you guys. Yes, I do have one more question here from John Morris. He's got 2 rental properties, so this one might be for you, Matt. I'm not sure. He wants to grow his portfolio. What is the best route of financing? He's in the Washington, D.C. area. So, yes, that's one specifically maybe for you, Matt.
Yeah, so I think we actually just did our little checklist we're working on for folks for something else where you sort of have to ask yourself 5 questions plus or minus that. How many properties do you currently own? If you have 2 and you're sort of below the 4 limit, sometimes actually a conventional lender might be your best. It's going to be always going to be your cheapest option until you own a certain amount of properties. Typically, that means 4. That also depends if you're self-employed or if you're employed, and depending on how much income you're able to document. As Dennis pointed out, if you're going to a conventional lender, unlike us, a conventional lender is going to be very difficult in terms of documentation of your income, assets, and other properties you own will count against you effectively. So if you have strong tax returns, you're not self-employed, typically up to those first few properties, if you're not in a time crunch, conventional under 4 would probably be the best route. Now, once you get beyond that, or if you are self-employed, folks like ourselves are typically the best option. Is then for us, we look primarily at the property cash flow and then base it some part on your credit that would just determine the actual interest rate. So your rental income itself is really what determines how you get the loan based on your expenses. So as Dennis keeps on going back to your rental yield, the bottom line really comes down to, do I make enough rent after my expenses to cover my mortgage payment? And is that ratio, which is commonly called a DSCR ratio, is that enough to sort of support the loan? That's how we and some other people that are in the private lending space primarily evaluate versus some of the more stringent things the bank would. So that was a long-winded answer to, I'm sure we could help you, unless you already have a very good relationship or don't care about taking 60 days with a conventional lender.
Okay.
I think that's one more that came in before the Johnny, I think for Dennis, about the overall, like where does he see, we talked about Indianapolis, where else does he see pockets of opportunity in the country that maybe he could share for most of our guys are obviously not institutional investors, but where do you see these pockets of opportunity you talked about? It was sort of that under 120,000 sort of purchase, and what other pockets of the country could you see as a good opportunity for people?
Yeah, I'm happy to give some color on that. So yeah, you're right. I really like properties both between that really $80,000 to $120,000 mark. But once you get, in most markets, once you get below 80,000, you start to have issues as either a landlord or a property manager, or both, in terms of late rent payments, turnover, and just a lot of other operational issues, because as obviously you delve into cheaper and cheaper properties, there are socioeconomic issues that at play there, where the crime rate is generally higher, the schools are worse, they're a little harder to lease up. So I like that. I like that sweet spot of 80 to 120. In terms of geography, a couple places that stand out to me still that I think are interesting opportunities. You know, I mentioned Little Rock as one. I like Dallas a lot, even though Dallas is a big market. It is doing everything right, where the home price appreciation isn't crazy, because they can still add supplies necessary on the home building side. Home prices haven't skyrocketed. There's been consistent rent growth. It's really got all those kind of factors in play that I like to see, even though it's a big market. And in that market, you're probably playing more in the 125 to 185K market, because it's a slightly more expensive market. I like Oklahoma City a lot. Even though I said people are moving out of Oklahoma City or out of Oklahoma, people are actually moving into Oklahoma City. So there's a lot of strong fundamentals there. I also like suburban markets around some of the larger metro areas, Chicago in particular. Chicago has gotten obviously an awful rap because of the really the crime and gun spree that has been going on there over the last couple of years. The vast majority, I mean, I'm talking 95% of that is happening in the south side as a result of them tearing down Cabrini Greens, which was basically one of the largest housing projects in the U.S., and now you have those residents kind of disseminating throughout some of the south suburbs. If you are in the western suburbs or the northern suburbs of Chicago, you get an okay price appreciation. You have good affordability. You have strong job growth, as people tend not to want to live in the city in Chicago anymore. All those factors are at play there. So I've seen some extremely strong portfolios there. And to Matt's earlier point about the older housing stock, that's one of those cities. You know, it's obviously one of America's oldest big metro areas. And because of that, when you go into that first layer or second layer of suburbs around Chicagoland, you're getting houses that were built in the 50s, 60s, 70s, and giving you a good opportunity if you're more of an active investor that will go in there, fix it up, and then rent it, renting an occupied property. But we have, you know, we have a number of Chicago properties that we just listed that are already renovated and cash flowing, available for people that want to look at that market and don't want to do the legwork.
It seems like there's some pockets. It seems like, again, institutional, if you stay out of pockets where institutional for whatever reason is scared, it seems like in Michigan, for example, there's sort of this halo over Michigan as a whole from institutional not to touch, primarily because of some pockets of Detroit. So we see some clients in the Michigan area, some of the suburbs that, you know, really weren't, you still, mind you, the automotive industry is still a massive, massive industry, and you have a lot of highly educated people that work in automotive and some great schools. So you still have a lot of good opportunity in Michigan. It seems like I've just seen it, not from personal, just from clients I see come in with
Matt, you're right. You also have, what you have in Detroit is really this giant reinvestment in the Detroit community, never mind the suburbs. Obviously, there's a lot of Detroit that's blighted, and it's, you know, it's definitely places you don't want to invest in because the city's just as apt to knock down a house as it is to improve it. But you know, think of some of the things that have gone on there. You know, Dan Gilbert moved Quicken, you know, essentially into Detroit. He bought up a number of buildings at a huge discount and is fully vested as one, you know, he's one of America's most successful business people. He's fully vested in really gentrifying that market back and making downtown a thing. Another good little case study is Shinola, which, you know, is basically was a dead brand from the 20s and 30s that the founder of Fossil Watches created. You know, that company alone is going to have 150 million in revenue this year. Those are just good little stories about people that are kind of part of the collective movement towards really making Detroit a big hub again.
Hey, Dennis, got a question that just came in for, I think both of you guys could probably answer this one. It's from Benjamin Redfield. He's asking, there seems to be a great opportunity around Buffalo, New York. How would you recommend or surrounding areas as locations to start picking up properties? So maybe some of the research that you've done for the Northeast that could shed some light to that. And then also maybe Matt from some of our other perspective.
Sure. Well, I think I mentioned in the presentation that Buffalo was one of those ones that Buffalo's, you know, not one of the 25 biggest metro areas in the country, but it's certainly one of the biggest investment markets. And that really is because it has historically had a high percentage of rental saturation, meaning rentals make up a higher percentage than the national average of the housing stock there. You've got a decent employment base. It's not going anywhere. You've got a lot of education and universities in that area. Albany's the same way, where you look at some of these places that are in more upstate New York and in the Northeast, where they're not towns that are going away, and they're not towns that are going to be on fire, but they produce a good yield. And so some of the people listening right now, you know, real estate doesn't have to be a home run. If you look at most people's real estate portfolios, it's littered with singles and doubles and the occasional strikeout. And so when you look at this as an alternative investment, you know, would you rather put your money in a corporate or a muni bond earning 2.5% per year and that's it, or something where you can really have a higher level of return and have that potential upside for appreciation while still really not experiencing the downside of risk that other alternative investments might bring?
So in terms of like leveraging like a rent range for, I think he's looking specifically maybe, how does he evaluate it properly? So listen, we're not big rental investors. I mean, we're focused on building out, you know, great private lending company, but generally I usually take sort of a data-driven approach. It's my personality probably. It sounds like Dennis too, but you can use great data providers like Rent Range and pull, say, Buffalo, for example, and you'll probably could start with a map and say, listen, I want to focus on these particular areas. I'll pull in the data and say, rent goes for $1,200 on average for a two-bedroom in Buffalo in this area. And then you're going to talk to realtors and those types of folks and get a better gauge on your rent yield. And then you start digging in more and more, I think, by talking to local folks. But you can start, Dennis, I mean, maybe you can speak to this, like starting high and then going local, basically?
Yeah, absolutely. So I would tell you the best way to kind of get an idea of how a local market looks is the easiest way to kind of look at individual properties quickly and get an idea for kind of what they rent for and what they sell for. You go to investability.com, you type in Buffalo, up pops the map with all of the available properties there in the MLS, and it will show you what the properties are listed for. It'll show you what the property should rent for if it's not already occupied, and then it'll give you all the other financials, including you can build in what kind of financing you want. You can assume property management fees, no property management fees. We give you what the taxes are. That gives you a good idea to kind of play around at the market, and then once you start to hone in on properties, then you can go to Rent Range and you can order property-specific reports or even market-level reports, depending on how much data you want to do. and we'll give you that extra level of insight. And then really the next step is, okay, I found 6 properties I like in Buffalo, but I don't live in Buffalo. Who are those service providers that can help me? Who do I need for titles? Who do I need for property management? Who do I need for my renovations? And that's all stuff we provide on Investability as well. So that's what I kind of meant earlier. We really try to be the one-stop shop for people between the different services we provide between Investability and Rent Range.
That's great. Jenny's, any other questions? Or we've taken a lot of time already. Hopefully people got some value. Any questions still remaining? You might be on mute still.
Yeah, just more commentary actually from Ricky Rodriguez, one of our attendees from Port St. Lucie, talking a little bit about that market, still having some opportunities for fix and flip activities in older areas and some rentals in newer sections of the city. That's a pretty good mix according to him, but no more questions have come in thus far.
Okay, so why don't we, you want to wrap it up here, Jenny? And
yeah,
really appreciate it.
Yeah, so again, for those of you who are still sticking around, and I see a few of those folks there, thank you so much to Dennis for his presentation, knowledge, and insights on the state of the single-family rental market. Same for Matt Neisser. And what we'll do is, as promised, we'll get this recording in the next couple of days back to those folks for taking the time to attend this evening. Again, thank you on behalf of LendingOne and Investability for participating in tonight's webinar. Have a great evening, and thank you once again.
Thanks, guys. Appreciate it.
Thanks, Jen. Bye-bye.